That's the closing bell on Wall Street, and now it's market domination overtime. We're joined by Blikre to get you up to speed on the action from today's session. I'm going to start with the close here of the major averages. The Dow finishing down by about 889 points here, very slightly up off the lows of the session when it was down almost 1,100 points, but still down 2.2% is nothing to sneeze at, as we have seen a continuation and extension and deepening of the selling that we've been seeing as of late, with a lot more forecasts being cut for economic growth. Now, even though we have bandied about the word recession in discussing the concerns out there, if you look at the estimates from Wall Street, from economists as to what's going to happen in the U.S. economy, they aren't looking for a recession. And that's certainly not the base case. They are looking, in many cases, of a slowing from the growth that we saw last year. The question now becomes how much and at what point does that get priced into these markets? So that is the process that it looks like market participants are going through right now, as they still raise questions about where the tariffs are going to end up, for example, foremost on their minds. The S&P 500 down 2.7% on the session, it too closing just off the lows here, and the NASDAQ down about 4%, the worst of the three major averages. Just to go back to the S&P for a moment, I was mentioning earlier a note I saw from Jonathan Krinsky over at BTIG, where he talked about 5,600 being sort of the support here for the markets. 5,600 is actually right here on this chart, but that's an area where he said perhaps would form a little bit of support. I'm going to turn it over to Jared now, who knows a lot more about technical levels than I do.
Well, thank you, Julie. You don't have to know much about technicals to appreciate some of these large numbers. Just going back to the NASDAQ, down 4%, worst day, I believe, since 2022. I'm going to be checking the numbers after I finish right now for the final closing numbers of the day. Now, here's the VIX. VIX shot up to 28, but it has no signs of rejecting some of those levels and dropping back down as it is want to do many times. It seems very comfortable hanging out in the upper 20s, and it just seems like there's a little bit more to go here. Don't quote me on that, but let's take a look at the 3-month chart in the MOVE index, because that is similar to the VIX, but it's for the bond market. Not quite at the highs here. We're not seeing that jump the same way that stocks are. And then taking another look at the 10-year T-note yield, that was down 10 basis points today, nothing to sneeze at. And let's get into the sector action. So sector-wise, utilities and energy were in the green today. Utilities actually up 1.11%, and that is in the opposite direction of tech and consumer discretionary, both down more than 3%. Communication services in third, and this just highlights that the NASDAQ 100 and the mega caps really taking the brunt of the selling today. Tesla down 15%. I believe that's the worst day since 2020. I think you got to go back all the way to the pandemic for that one. And I could cycle through a lot of these, but you're just going to see a lot more red on the board and not a whole lot of green today. Guys?
All right, thank you, Jared. Markets closing just off the lows of the day as the NASDAQ sees its worst one-day performance since 2022. Joining us now is Rob Conzo, the Wealth Alliance CEO. Rob, it is good to see you. So investors clearly seem worried here, Rob, that Trump tariffs and government firings are going to potentially sink this economy. Do you share that concern, Rob?
Well, listen, it's hard not to feel some of that concern, especially when you see like the Michigan Consumer Confidence Survey at its lowest level since April. The American Association of Individual Investors since 1987 at 7 times the lowest, where bears 60% feel that's going to be bearish. Interestingly enough, every time after those 7 times since 87, the market annualized 24% rate of return. But yeah, you have a VIX going through the roof, 28 in the end of December, dropped down to 15, back up to 28. 10-year, the end of February, going from 450 to 425 in a week. Yeah, it's volatile. That's the name of the game right now.
It is volatile, and in particular, we've seen a big sell-off amongst growth names and tech names, right? Consumer discretionary, yes, but also a lot of selling in tech, a lot of selling in the Mag 7. What do you make of that, and do you think this presents an opportunity for investors?
Yeah, well, I mean, look, asset allocators, diversifiers like us feel good when they start to see a market round out. And that's what you're seeing. Yeah, you saw the S&P normal down 3%, but the S&P equally weighted is flat to down a little. That's good. International, unsung hero, up 10% year to date. Areas like MLPs, up 3% year to date. Defensive sectors, consumer staples, healthcare, right? Doing pretty good. Utilities doing pretty well. So, asset allocators, diversifiers like to see this. We had some big years of the Mag 7 dominating, skewing indexes. So we're not necessarily down on it. In fact, I feel pretty good about getting into other areas of the market and diversifying and taking advantage of some things that are going on right now.
Do you try, Rob, and gauge when we could be at a bottom? Do you try to watch certain technical indicators, for example?
Yeah, calling the bottom is, as we all know, that's pretty tough, Josh. What we do see is when you see big market declines, especially in certain sectors, tech, large growth, drop big, that's a time to call out a rebalance, buy some of those shares low, and get back into it. So you're not really calling a bottom, but you are signaling a time to buy. Maybe take some tax losses as well. Big volatility is not necessarily the worst thing in the world. And coupled with some of the other things, you got to start keeping a broader perspective, I think, about what's going on. There's some things that are pretty good right now that investors are kind of losing sight of that I think they should.
And so losing sight of just the need, I guess, to look for opportunities at a time when we're seeing this volatility here. What kind of sectors do you think are attractive?
Yeah, well, a couple of things that we've been looking into. Number one, infrastructure is something on both sides of the aisle that's talked about a lot. Roads, bridges, data centers, power grid. That's a great way of taking advantage of some things that are happening right now. As I said earlier, MLPs were great the last 3 years. Year to date, they're up 3%. Sectors, like I said, healthcare, as well as utilities, defensive, pretty good value. Value right now is up. Large S&P large cap value is up 2.5%, while tech is down about 5.5%. So keeping your eye on the ball about these other areas that were kind of forgotten about, pretty good. And let's not forget about bonds. You could have high yield munis right now, low default risk, getting 5.5% interest. That's pretty attractive. So there are ways of kind of gaming this market and coming out okay.
What about looking outside of the U.S.?
Well, listen, our international managers, like I said, are up around right now 10, 11%. So international is something that's lagged for a long time. And that's the beauty about diversification. You hate to say a boring word like diversification. No one wants to hear it. But no one saw that coming. Year to date, an international index up 10 when the S&P is down 3. So yeah, there's areas that managers are taking advantage of, and I think there's a way you could definitely do pretty well. I also think just overall, when you see, although it seems like people don't care as much, CPI moderating since February of last year. That was core, 3.2 to 3.3. PCE moderating since June, 2.8, just ticked down to 2.6, and wage growth at 4. So you got PCE at 2.6, wage growth at 4, wages are going up much greater than inflation. That's a good thing with historically low unemployment and company earn some pretty good earnings. I think if we keep this all in context, the world isn't falling apart and not too many people are signaling a recession.
The world isn't falling apart. Rob, we will leave it on that high note. Thank you, sir. Appreciate it.
All right, thanks.
Turning shares of Oracle as its third quarter results are just hitting the wires. Let's get you those numbers. Q3 adjusted EPS 147. The street wanted to see 149. Revenue 14.13 billion. Estimates 14.39 billion. So that looks like misses there on the bottom and the top. Also call out Q3 cloud infrastructure revenue. Let's get that number. 2.7 billion. The street was closer to 2.71 billion, Julie.
Yes, and the Larry Ellison, who's now the chairman and CTO, talking big here, saying we're on schedule to double our data center capacity this calendar year. Customer demand, he says, is at record levels. So obviously he's talking, optimistically, even if these numbers are disappointing versus what the street was looking for.
Yeah, I also see some comments from Oracle CEO, that's Safra Katz. She's talking about how Oracle signed sales contracts, she says, for more than $48 billion in Q3, how they've now now signed cloud agreements with several world-leading tech companies. She calls out OpenAI and Meta, NVIDIA, and AMD here. But we'll need a better explanation of why exactly they missed on the top and the bottom there versus expectations.
Yeah, we will. We'll have to take a closer look at that. All right, coming up, we're going to hear from an analyst on the other side to break down the latest earnings results from Oracle. Stick around, much more market domination overtime coming up. Oracle missing estimates on the top and bottom line for the third quarter. The company did also lift its quarterly cash dividend to 50 cents a share. Here with more on the quarter, let's get to D.A. Davidson Managing Director Gil Luria. So Gil here, interesting sort of a mixed picture, I guess, if you will, because the miss, but then a little bit of carrot here offering that dividend. What do you make of it?
Yeah, it's a balance between the business Oracle is currently in, which just missed the low end of guidance, and the business they are moving into, and they are guiding very aggressively into the next fiscal year. They guided to 15% growth next fiscal year. Expectations for them were still single digits heading into the quarter. So that's the good news. That's the ambitious part. The not as good news is they couldn't even meet the low end of their guidance range for this period, for the period that just ended in February. And so we'd have to evaluate based on this call, how realistic is it that they can get to 15% revenue growth? And at what margins is that going to come in? Because their current business is a very profitable business. The business moving into, which is, I'd call it surplus GPU rental, is not as high a margin of business.
Gil, when you think about the big, great cloud competition out there, and you think of the big three, Amazon, Microsoft, Alphabet, how does Larry Ellison's company now stack up there?
So the good news is that Oracle Cloud is built on the new infrastructure, meaning they've only have the NVIDIA GPUs and Mellanox networking equipment. They don't have legacy hardware that the big hyperscalers have, which is what's allowed them to become a share gainer, even if from a very, very small base. Now, going forward, the big expansion of their business is the GPU rental business that's grown very fast for the hyperscalers, but is growing even faster for Oracle Cloud. And part of the reason is that they're really the overflow provider. They even have a deal with Microsoft that's giving them some of their volumes because Microsoft hasn't built out data centers fast enough, so they're shifting some of their volumes to Oracle, which is why the RPO number grew so fast in the quarter, because they're signing these long-term deals, among others, with the hyperscalers that can't handle all the demand themselves right now.
Gil, this is one of these moments when I'm going to ask for a pause. RPO, remaining performance obligations. For those who are watching who don't follow the lingo and Oracle like you do, what's the significance of that to the company?
So that's the value of all the contracts that they've signed going forward. So they haven't recognized yet. So that's not revenue that they've already recognized. That's revenue that's coming. And so when they say that they have $130 billion in that means that that's revenue that's contracted that they will be recognizing over the next few years. And it gives them some visibility, gives us visibility that they can grow from here, because that's far greater than the revenue they've been recognizing.
Gil, you got a neutral on Larry Ellison's company. How come, and what would it take to get you more bullish?
Well, the neutral has to do with the fact that we keep talking about OCI, which is less than 20% of their revenue. About 60% of Oracle's business is a declining business. So they really do have to grow OCI very, very fast in order to make up for the fact that their core business, most of what they sell, Oracle databases and ERP systems, is a declining business. And then on that very fast growing part, when I say that they're overflow, I don't mean that as a good thing. Once Microsoft, Amazon, and Google have enough capacity that they can handle all the demand, which could be even later this year, there's not going to be as much overflow. There's not going to be as much room for that fourth player, and especially there won't be that direct demand from Microsoft into Oracle. So next year they have a path to grow faster, but I'm not sure it's the kind of growth that you want to get if it's spillover from your bigger competitors, especially if it's coming at much lower margins than your core business is at today.
Hey, Gil, while we have you, I want to take a break from Oracle and ask you more broadly about what's going on in tech, right? And obviously, we had a very broad-based sell-off today. But when I look at the Mag 7 in particular, most of them have now wiped out, or they're very close to having wiped out their post-election gains, right? We saw big declines today in everything from Apple to Alphabet, right? All of the Magnificent Seven in large cap tech. So what's the deal, Gil, right? At what point, obviously there's a sentiment issue, there's a growth concern issue out there. Do you think these guys are being unfairly punished, or do you think that there is a re-rating and a re-rationalization for some of these big cap tech stocks?
It varies by the mega cap, right? So if I was to think about a company like Microsoft, even a recession doesn't damage their earnings power that much. Same for Amazon, for Meta maybe a little more, for Google maybe a little more. I'd be more concerned about a company like Nvidia, because if global optimism and AI optimism subsides, their big customers can just decide to just hold off on spend for the foreseeable future. So it's a range of outcomes here, but broadly speaking, for most of the mega caps, their earnings visibility is pretty good. It's better than most, but they have been trading at a very big premium based on that. And if the global visibility into the economy is now a little murkier, the market is just less willing to give high multiples on anything, even companies with good earnings visibility. So there's still good stocks. Now they're just trading closer to their historical multiple range as opposed to a big premium, which was the case even a few weeks ago.
Gil, I want to switch gears, ask you about another name you cover, which is Apple, because we saw those headlines, Gil, Apple delaying an upgrade to Siri enhanced by AI. I'm curious what you made of that, Gil, and what it means for the iPhone upgrade cycle.
It may be keep getting pushed out, right? We thought Worldwide Developer Conference almost a year ago that AI features were coming. They'd be in the iPhone 16, drive the big upgrade cycle. We then realized that it's going to be a slower rollout, and we pushed our expectations out. And now it seems like we may need to keep pushing our expectations out for an upgrade cycle. That's the not as good news. The good news is that those AI features will come. They will be compelling, and we will want to buy new iPhones that incorporate those features. It's happening. I know that, for instance, for me, email summary is a life-changing feature. The emails I get from my son's school are many pages long, and now I can just push a button and it tells me where I need to be and what I need to do and who I need to send a check to. So the features are good. They're important. It's just getting dragged out in terms of their rollout. And that's not even a global rollout. So there will be an upgrade cycle on iPhones. It just will be a little later than we anticipated even a few weeks ago.
Gil, always great to see you and to have you on the show. Thanks for joining us.
Thank you.
Now, despite the GOP having full control over the federal government, the chances of a shutdown this weekend continue to creep up, with even President Trump admitting it could happen. Yahoo Finance's Ben Worschel joins us now with more. Ben.
Yeah, hey Josh, we have a kind of a twice-a-year tradition here in Washington. It's like changing your clocks, where we flirt with a government shutdown, sort of, a lot of people would say very pointlessly. This Friday night at midnight is the latest deadline. This is when the government will shut down unless Congress passes a bill. And there is a 99-page bill that Speaker Mike Johnson unveiled over the weekend to avert it. The first big vote is expected tomorrow, Tuesday evening on this. And this is a bill that would extend the government funding through the end of September, and then would also do some other GOP priorities like defense spending and immigration border spending. The problem here is that, and the reason the experts give it the non-zero chance that there is going to be a shutdown, I've heard as high as 35% chance of a shutdown, is that it's unclear if Republicans can get behind this, and then it's unclear later in the week if Senate Democrats will give this the support it needs. So it has a whole bunch of steps to go between now and Friday, but this is the sort of latest example of government dysfunction that markets, I think, are pretty tired of, for certain.
Yeah, for certain. Ben, thank you so much. Appreciate it.
For certain.
Bank stocks under pressure as worries mount over possible U.S. economic slowdown. One bank in particular is finding itself in a complicated position amid politics of the new Trump era. Yahoo Finance's David Hollerith joins us now with more. So, David, tell us, what bank is it?
So it's Capital One. The president's family business sued Capital One in a Florida court on Friday, alleging that the credit card company debanked hundreds of its accounts following the January 6th attack on the U.S. Capitol. Now, this is important because debanking has been a topic that's gotten a lot of attention in Washington so far this year, and it's something that the president specifically has spoken about. And now seeing with Capital One here, it's pretty complicated given that Capital One is in the process of completing a huge merger that it's hoping to see close around mid-May. So as far as what the company says about this, it's pointed out that it's following the rules of the road according to the Bank Merger Act, and it feels it's well positioned to close its merger. But this is kind of the latest example of how things have been getting a little bit more complicated for banks. Going into this year, I would say that generally the story for banks has been wildly optimistic, given that Trump has signaled, and the Trump administration has signaled clear favor for sort of a deregulatory agenda. And what complicates this matter particularly is that the debanking issue is also something that Trump has talked about a couple of times. He did call out Bank of America CEO Brian Moynihan at the Davos conference in Switzerland. So we're kind of watching these two things play out together. And, typically in an M&A situation like this, you don't necessarily have to have a non-regulatory lawsuit settle before a merger is approved, but that all depends on the regulators who President Trump has obviously appointed. So we're going to be paying a lot of attention to this and see how sort of the Capital One navigates both of these things. But just in general, it's kind of showing that everything is getting a little bit more complicated from how investors had seen sort of the banking sector look at the beginning of the year. We still don't really know the Trump administration's position on these bigger mergers like Capital One. So the May closing for this, it could be pushed back. We could also see potentially more lawsuits, civil lawsuits, not necessarily from regulators, against banks over this debanking topic.
All right. Thank you, Dave. Appreciate the update. Time now for what to watch. Tuesday, March 11th, starting off on the labor front, the monthly JOLTS, that's the Job Openings and Labor Turnover Survey for January, is coming out in the morning. Economists forecasting the number of job openings to be 7.67 million. That would be an increase from December's survey, signaling a stronger demand for workers.
Taking a look at small businesses, we'll be getting another reading on the health of small businesses in the morning from the NFIB Optimism Index. That number expected to slide to 101 compared to the previous reading in December, giving us more insight into the sentiment and outlook of small business owners in the U.S.
And moving over to earnings, another round of reports coming out tomorrow, including Viking Holdings, Dick's Sporting Goods, and Kohl's. Dick's Sporting Goods is announcing results for the fourth quarter before the opening bell. Analysts expecting the retailer's same-store sales to surprise to the upside, driven by a strong holiday spending season.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's asking for a trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned.